Thank you, Melchior. Good afternoon, everyone. My name is Jochem, and I'm here with my brother Steven, who's in a different location, so I hope he's present. Steven, are you there? Oh. Well, not yet. He's actually currently on vacation, so maybe his connectivity is a bit less. Well, we are here to hopefully prepare you a bit for your budget next year. I really hope this presentation helps you a bit. It's a bit generic, but budgeting is quite a specific field, and there's a lot of different ways on how to do it. What we want to do today is we first introduce ourselves a bit and our background, and we'll go a bit into the basic corporate finance concepts, mainly the three concepts. The profit loss, balance sheet, and the cash flow. Where to put what? OPEX versus CAPEX, operational expenses versus capital expenses, which is always a key point for financial people, that you differentiate between the two. I'll explain a bit why that's so relevant and what happens to these two different items. The planning and control cycle, which will explain a bit for you where the budget sits and why, how finance operates and how it runs through a financial year. Then hopefully I can tell you a bit about the preparation for your budget. Hopefully that's helpful. And we'll close with a business case and some closing remarks. Steven, I hope you're there. I can't hear you, unfortunately.
No, can't you still hear me?
Yeah, I can hear you.
Okay, good. Hi, I'm Steven de Ruig. I'm the brother of. I've been working, started working at Pink Elephant, a really old startup in the technology sector about 40 years ago, I guess, and worked my way through KPN in the end. And then I joined the spin-off of Getronics. So Getronics was bought by investors, and now we are, the international part is still alive and kicking. And I'm doing the sales pricing architects, but at Getronics, I was responsible for the data center costing and CAPEX procedure, processes, business cases and stuff. So it's quite a lot of experience in that. Over to you, Jochem.
Yeah, and my name is Jochem, and actually Steven has a lot more experience in the cost calculation and budgeting field. I've been CFO of RIPE NCC, which was quite a broad role. I know quite a few of you from that time. Currently, I'm working as CFO of Freedom Internet, which is a startup, and it's quite exciting. We're setting up a new ISP in the Netherlands, and hopefully some of you will join us this year or the next year. Who knows? Well, why do we do this presentation together? I think I feel the experience Steven has and I have is quite complementary. He has a very specific experience in a lot of cost calculation, pricing, and that area, which I think really is quite interesting to you and can help you in your budgeting. And I have a more general overview in how other departments also look at budgeting and how the budgeting process works in companies. Well, to kick it off, we want to say that actually finance is not an exact science. It's not a 0 or a 1. What we try to do is to reflect the performance of the company in financial figures. And really, there is so many different laws, legislations, ways in how to do that. Maybe you've heard some of these, the Dutch GAAP, the US GAAP, IFRS. These are different reporting standards. And Also, a lot of companies always have different fiscal rules, commercial rules. Of course, it matters who you present these figures to. Internally, there can be a lot more detail into the figures, and maybe a lot more information is supplied than actually externally is done. A budget is most of the times a lot of an internal process, and internally to check how the company is doing. Well, then what is an asset, whether it's operational expense or capital expense? There's a huge variety in this as well, and it also depends on the line of business of the company. For instance, software development could be a capital expense or operational expense, depending on how a company views this and how they want to use this in the future. Then there's, of course, intercompany items, and I think which has been quite unique, but also in English notation, we use dots where in Dutch notation it's a comma, and the other way around, which is quite confusing, but I think the European mainland has a different comma and dot than the Anglo-Saxon world. So what we want to give you is that every company, every country, every financial person has a bit of a different view, and you got to try and understand a bit how your company looks at financials. So there's a lot of interpretation, but one thing, and it's kind of come back a bit in this presentation every now and then, cash is king. So if you can show your financial that it's a cash generating venture, they always become happy. There's always financial company specific, I call them trades. So every company has a different way in looking at it, as mentioned before. So even the company registration and structure will determine on the rules it has to adhere to. I used to work at the RIPE-NC, which is an association on the Dutch law. It has very different rules than when you're a limited company in the Netherlands, and what you have to publish and what you don't have to publish. Also, there are some choices that are made in financing and bookkeeping. What figures do we find relevant? What KPIs do we want to use? Then you have the size of the company, which can really matter. Like now I work at a startup company. We are very much focused on cash management and cash flow, while a large corporation probably focuses a lot more on their margin and how to optimize that. So again, try to understand your company's specific setup, the focus points that your finance department and the management has. Then basic corporate finance, we're just going to run a bit through some of these items. Well, first, the very basic concept, debit, credit, the balance, the profit and loss, and the cash flow. We'll cover all three. Debit, credit, well, you probably all know this. A transaction creates a booking, a journal entry, and a booking always has two sides, a debit and a credit side, which equates to left and right in many ways. Debtors for a company are third parties that pay to the company. Creditors for a company are third parties you have to pay. I'll run a bit quicker through these slides because they're not the most juicy, but I think they're relevant background information. Looking at the balance, which apologies, I wrote in Dutch. You have the asset side on the left, and in the Dutch way, the fixed assets are on the top and the other assets are at the bottom. In English notation, you use it a lot of times the other way around. On the right-hand side is the liabilities, where your equity is, and your debt, long-term and short-term. So just to understand where your capital expenditure will go in here. The profit and loss, we've tried to summarize quite in a short fashion. Of course, you've got revenue, then you got the cost of the revenue, and you get to a gross margin. Then you have many different items which can be a bit company specific, but there's always going to be personnel, direct personnel that is related to the revenue stream, the business unit, or the product, but also indirect, which could be staff or other indirect costs related to personnel. Then, of course, you have your suppliers costs like consultancy, maintenance, etc., and other costs like IT, overhead. This then, if you deduct these from the gross margin, will come to what we call in finance the EBITDA, which is an acronym which is very often used, and it stands for earnings before income, taxes, depreciation, amortization. So this is actually how much you earn before all kind of other items are deducted, like taxes and the depreciation of your capital expenditure. When you actually take the capital expenditure away from that, you end up with the EBIT, and that's also a figure that's quite frequently looked at. When you deduct the financial costs and taxes, you come to a net result. This is not cast in stone. A lot of companies have different ways, different items they add to coming to a net result, but this is roughly how it looks. Cash flow.
Yeah. If I may add, what you often see is that the depreciation is added to the cost, so you get the EBIT immediately. For instance, when at Pink Rocada we used to have it. We used to be the EBIT was the most important, and only later on, especially in the KPN business, the look for the EBITDA became more. So it all depends on how the board is managing the company, and therefore you should ask your board or your owners how they will manage the company. Why people look at the earnings before income, taxes, depreciation, and amortization is that you cannot do anything about it. So the other costs, the personal costs, supplier costs, that's the one you can influence, and depreciation and amortization are long time fixed costs running, and so that's what I would like to add. Jochem, over to you.
Yeah, thank you. The cash flow is, I think, the third financial overview that is common and quite a key integral part of financial reporting. So just to be clear, a balance sheet is kind of a photograph. At one moment, you look at how the company is looking. The profit and loss is over a period of time, whether it's a month, a quarter, or a year. That depends. And the cash position as well is like a video. It's over a period of time. So what you look at, for instance, you take the cash position at the beginning of the year, you look at the inflow, you look at the outflow, but you actually look at the cash going out. So whether it's CAPEX or OPEX, that's not that important. And taxes also flow through this cash overview. I think maybe a good analogy is you can just see it as, let's say a company has one bank account and it has one bank balance. The cash flow will show you then how the bank balance is doing. Then I think quite something where a lot of mix-up happens and difference of opinion is the operational expense versus the capital expenses. As mentioned before, a lot of companies have different ways in how they look at it, and it can deviate from company to company on what they take as capital expense and what as operational expense. But as a rule of thumb, operational expenses are recurring expenses like service fees, monthly fees, one-off smaller items. You could say as a rule of thumb, when it's below 500 euros, it's going to be an operational expense. So operational expenses are directly taken in the profit and loss. So you don't see these on the balance sheet. Then on the other side, we have the capital expenses, which are larger purchases, investments, but it also could be intangible items like software development, for instance. When you've had a new software tool built, then this could be taken as an asset on your balance sheet. So that's where you find the capital expense on the balance sheet. An asset has a lifespan, a commercial and a fiscal lifespan. There's different terms for that. And it's depreciated over time. And depreciation then goes into the profit and loss. And this is what Stephen mentioned, that this is kind of a fixed cost. So when it's on your balance sheet, it's going to give a recurring cost over time. So why is this difference so relevant? Well, it impacts the profit and loss in a year differently. OPEX has a larger impact, CAPEX smaller on a given year. So OPEX more variable component, while CAPEX is a more fixed component. CAPEX a lot of times is part of a strategic long-term or an investment business case that runs over several years. And I think for financial people, why CAPEX is always a bit different is that there's different financing possibilities, which could optimize your cash flow. Financial operational needs are a couple of those. Then the planning and control cycle. Stephen, I think you know a bit more about this, so maybe you could talk through this.
Yes, well, the planning and control cycle is usually what happens so at the end of the summer, when you start planning what you will do next year. A director once said it's really easy, you just tell them what you want to be later in your life, but it's not that easy. It's there's lots of fields. So the first field will be that you there's the long-term outlook you will have. What will be your products and stuff, and then you break it down into smaller components, and you work downwards until you get an outlook, basically per quarter, sometimes per year. It's the whole point about this is that when you have made a decent planning, you can see it's easier for the finance department to see whether you are deviating from it, and it's especially in this big data time. Sometimes the systems can find deviations much sooner, much earlier than you would find them yourselves. And then, so that's important. Could we go to the next slide? So how does it work? So first you do the planning, and then you start executing. So in the beginning of the year, you're running your plans, and then every month the finance department will tell you how much you deviate from it. That's the monitor part. An important time at that is that you then have to do the review. In the review, you have to be really careful on if things are really going as according to plan, or maybe it only looks that way, and then some costs are way off, and some costs for the good, and some costs are way off for the bad. So that's one of the things you really have to be careful about. And from my experience in IT, it often happens that especially maintenance costs can be quite different from planning. And this also accounts for a quickly growing product. And we all hope we have a product which will double or triple in a year, and then you have to be really careful that the cost parts remain in control, and you don't have much more expensive products when it has grown, because then you run out of control. Next slide, yes. So Jochem, this is probably one which is more your part.
Yeah, I think this is just a bit more even tactical way of looking at it. So you do your resource planning, then you make a cost estimation. From that, you build your budget, and then afterwards you control the cost. I think it just visualizes a bit what Stephen just mentioned. And I think why we're telling this, that you actually, engineers and operational departments, provide a key part of the planning and control cycle, mainly in the planning, of course, where you can actually help build a good solid budget, but also in the cost control, which you all take your part in. So now a bit into how to prepare your budget and why budgeting. Well, as mentioned, we see this as part of the planning and control cycle, which is a bit the heartbeat of financial departments nowadays. It's really the financial planning for the business to give a financial insight into the future. And of course, you look back into the current affairs, and from that, try to project onwards. A lot of times it's, of course, an internal process, but the figures are mostly used internally. It's very infrequent that companies detailed show what they budgeted for towards the outside world. It's a lot of times an internal thing. The estimates they have, they'll present it to their board, and the board will approve it. It also sets the financial framework for the planning and how the year is going to look. So we tried here to give you a bit of a tool on what is a way to approach your budget. Well, first work out your plans. I think you probably already done that, but anyway, start with that. Then consider all the details of the plan. A lot of times I hear people, this is my idea, this is what I want. And then financial starts asking all these questions like, so how many servers, what connections, blah, blah, blah. But the more detail you have, the better budget you can build. It really helps financial people as well, but also for yourself if you have a detailed budget. And then from that, you can build a solid budget for the year. Well, this is a bit an open door, as we say in Dutch, but we do want to mention it. Don't underestimate. I mean, it sounds like great. This person has a really tight budget this year. That's fantastic. But if that could mean you can't execute your plans, or when you try to execute your plans all the time, your budget is too constrained, and you have to go to your management to get approval. So I really think underestimating is not the way to go. But overestimating is also not a very wise way forward, because a lot of times you see big budgets coming in as a financial, and then right away, okay, this deviates too much from the previous year. This will impact the business case too much. And then there's a long road ahead of you and your financial person to get to a budget which is a bit more realistic. So I think it really helps if you have a realistic budget. When you put a server and you know the price, put that price in, don't mark it up with a certain amount. That's just going to lead to a lot of extra discussion with your finance department. So what helps in working together with your finance department is prepare a detailed, well thought out budget. Think a bit further than 1 year. A lot of business cases, projects have a longer lifespan. Also, if you implement, let's say you build a whole extra network or couple of extra racks that will also have an impact for the future years. So think about that, and also think about the reasoning. I think a lot of times in financial people, they don't always know the business that detailed and that well. It really helps them if you explain them in why you want to budget and for what amount. So just to give a silly example, so we're building this new piece of software to support patching our servers. Saves us an hour per month in maintenance so that we can quicker resolve customer issues and have an increase in customer service. This way, a finance person can then explain as well when this budget item comes up to his management and to the controller or CFO, why that item is budgeted. Well, then, of course, your finance department... Sorry, Steve.
Yeah. Well, one of the important things is that we often like to have the scenario. So that there's the bad case scenario and the best case scenario, and the worst scenario is especially important so that you know what happens when your product is not successful, whether you make a loss or you're just break even. And the best case scenario is important because when it triples or tenfolds the amount, that you still have the cost under control. And well, as I mentioned earlier, that's especially important. In my time, KPN had this new product, Digitenne television, and they had envisioned that they might have 30,000 people using it. And then in no time, there were 300,000 and then even more. And the cost of increasing their capacity was enormous, much more than anticipated and much more than the original costs. So it became a loss. Of course, they created a new product and then everything went fine. But you have to be careful about the best case as well, that you keep your products costs in order. Over to you, Jochem.
Thank you. Well, I think a finance department should assist you. I don't know if it always happens, but they should, of course, give you clear guidelines on the process, the timelines, and the templates. And most of you will probably get an Excel spreadsheet, which you have to fill out. But anyway, I think they should really help and assist you. And also, as I mentioned before, in the operational and capital expenses, they should very clearly know what in the company is operational expense and is a capital expense. Also, I think it's good if they give you a bit of an indication on the direction of the budget. A lot of times, of course, we think in a growth scenario, but I think that will give you a bit of footing on where to go with your budget. And then there could be other considerations, like as we sometimes call in finance, a contingency or an unforeseen budget. Sometimes this is possible, and it could be quite useful if you have a bit of a gray area where you can actually, which you can actually use in the next year or years. So how do we work on a budget? Well, in most cases, you start with an overall picture and you look at the growth in sales and the increase in cost. Somehow we always aim for a lower increase in cost and a higher increase in sales. The sales estimates, a lot of times the finance department is quite critical at it to increase them a bit. This also is a view of management a lot of times, that sales tries to lower this a bit while the finance department then wants to up it. And the cost estimates go the other way around. I think what's always a bit a conflict is the top-down and bottom-up approach. A lot of companies pretend to be bottom-up, build a bottom-up budget, while then top-down an X% is cut from the cost budget and the sales budget is increased by X%. So this is always a bit a gray area whether it's top down or bottom up, but it's good to understand this a bit, and every company has a different approach on how to do this and how to finalize. So now to wrap it up, we want to provide a short business case just to get your brain a bit thinking about what you could do with your budget. There's a lot of different areas and things you have to consider when looking at your business case. Of course, there's cost and revenue, which I think you will look at. But there's a lot of detail to look at: the completeness, the relevance. There's, of course, also risk involved in any business case. And as a financial, you try to actually make that material on how the risk impacts the financial business case. Margin, does the margin meet the internal goals set? It's quite an important KPI for a lot of companies, whether a business case has a solid margin. Cash flow, you see that more and more now, and a positive cash flow is very important, but also there's indicators like net present value and weighted average cost per capital, NPV and WACC. Beautiful acronyms, which are used actually to determine whether a business case is a valid case for that company. And all in all, there's also the process control when a business case is pushed forward. So what we did in the case, and actually my brother built this case several years back, but I think it's very accurate still. What if you have 600,000 euros available to invest? The sales comes up with 3 different opportunities, 3 different cases with different lifespans, a 3, 4, and 5 year lifespan. The total cost for these 3 opportunities are the same. The annual cost of the maintenance personnel, etc., is a percentage of this investment value. To show you how that total cost looks then is, so we have that investment of 600,000, then the maintenance personnel is 50%, other costs 30, indirect costs 27.5. All in all, total project cost a bit over 1.5 million. Okay, this is a lot of information on one slide. I won't go endlessly in detail. What I want to mention is in case A, the 3-year case, what you see, of course, is that the costs are a bit higher in those 3 years, while in the other case you see them being lower. So the total project costs are higher. The total income is also a bit higher, estimated. The profit per year comes out to 85,000, profit margin 14%. I think our main message is already that you can see 3 different cases. Depending on what you look at, you might select a different case. If you look at increasing your sales, you'll take case A. If you look at the profit amount per year, you'll take case B. Or if you look at the margin, you'll take case C. To zoom a bit more into detail on how finance looks at a business case, there's this concept that money loses its value over time, and that's a cash flow net present value concept, so that you recalculate future cash flows into current day value with a discount figure. Of course, there's also the payback time, the time it takes to recoup the initial investment. And if we show these 2 into the analysis of the 3 cases, we can actually see that the net present value for the second case is the highest out of the 3, but the payback period, so the time it takes to recoup the initial investment, is in case A the fastest with 2.5 years. You can see, depending on what you look at, you'll select a different case. The orange being the most negative and the green being the most positive for a given parameter. So what we want you to take from this is that focus on different financial parameters will lead to a different choice. in different companies, a different case will prevail. So it's very valuable to understand the company focus, whether it's on cash, on net present value, on revenue, or on another indicator. So the conclusions we would like you to take from this, make sure you have a good differentiation between your operational and capital expenditure. Think longer term in your budget. And maybe the most important, engage and communicate with your finance department on the budget. They should support you, they should help you, and together you can build the right, realistic budget. And the last thing is, of course, the love for MS Excel in finance. I think it's the tool of choice, but yeah, it's what we use, and it does the trick for most finance departments. Stephen, any last conclusion you want to give everyone?
I do agree totally. And also think in scenarios. So be careful. If you do the budgeting, make sure you know what happens if the volumes stay low, and what happens if they run amok. And because that's also really important. Thank you.
Thank you.
Thank you, Jochem and Steven. This was really interesting to sort of get a deep dive in 20, 25 minutes into the world of finance. I learned a lot from it. You also unraveled a really interesting discussion on IRC, on our IRC channel, with regards to if IT is a cost or an asset. In other words, maybe that's a suggestion to you as finance folks, where the some parts of IT are actually a cost, but the knowledge people have could be an asset. So that would be maybe interesting for your reporting. Just a suggestion to keep the engineers happy. There was also a question. What is your opinion on the current popular use of equity IRR, internal rate of return, as a measure of value?
Steve, I think you have quite some experience with the IRR.
Yeah, well, IRR is the net present value, which is 0, of course, and at KPN, which is capital intensive, IRR was the really important. But then we always looked at the net present value to compare business cases, because often there were multiple groups of engineers trying to create a solution, and then the business cases were compared based on the net present value. And IRR is for me, is simply it tells you when it's 0, so it gives you a percentage. So it's the same. And yes, it's for a business case, especially when there's CAPEX in it, it's the most important parameter there is.
All right. Big thank you, Jochem and Steven, for this really interesting deep dive.